Hey Snapchat, today I'm going to cover the topic of stock options. I'm going to explain how they work at a startup. Everyone kind of knows what a stock option is, and I'm going to tell you today specifically what a stock option is. First, a stock option is a right, but not an obligation to buy stock. There's all sorts of options that exist in the world. Investors often secure the right to do something, but not the obligation to do something. That's what option is. And an option is something usually that you have a period of time to make a decision on whether or not you want to take up the option. So if a company has 10 million total outstanding shares and is giving you 100,000, that's equal to 1%. If you own the shares, that's just stock. If you own a right to buy the shares in the future, that's a stock option. Knowing that you have 100,000 options is totally irrelevant unless you know the total outstanding share or unless you know the value of your stock option. Now you remember I said at the start that a stock option is a right but not an obligation to purchase stock in the future. You don't actually get your option for free, you have to purchase it. I'm going to tell you what that purchase price is. The purchase price of a stock option is called the strike price. That's the price at which you must buy the option. So you can actually have a company whose stock price is $10 per share, but your strike price is only $1 per share. In stock option terms, this is normally called in the money because it's already worth something if you could actually sell. Sometimes in a down round, your strike price ends up being higher than the stock price. You may have heard this. People call that underwater. So how does someone actually determine the strike price of a stock option? Of course, there's different scenarios stock options are given out. I'm going to talk about the most common scenario, which is an early stage startup. Governments won't allow you to simply hand out stock for free because it's considered compensation that should be taxable. So a stock option has to have a strike price associated with it. In the United States, this is determined by something called a 409A valuation. But if you're not in the US, nearly every company has some legislation to determine the price of a strike price of an option. While every situation is different, in an early stage startup, the most common scenario, if it's venture backed, is 20 to 40% of the preferred price. The reason you can justify a discount is common stock is often not as valuable as the investor class of stock called preferred stock. The reason is preferred stock has rights associated with it common stock doesn't, like liquidation preference and voting rights. It's important to note that stock options doesn't mean you own the stock yet. You don't own it, and therefore you can't vote. The first part of owning stock option is vesting. If I give you 100,000 stock options in my company, you actually have to earn those over a period of time. The actual reason for vesting is that stock options are supposed to be an incentive for you. They're supposed to be an incentive for retention. You probably know this already, but the most common vesting period in the US and around the world is a 4-year vesting program where you have what's called a cliff at 1 year. What the cliff means is that in the first year, you actually don't earn any of the stock options. Then you get 25% at the end of year 1. And after year 1, you tend to accrue your vesting monthly. The reason for the cliff, you don't want to feel like an employee joins and quits 4 months later and walks away with value in the company. For 4 months, they probably haven't earned it. But even after your stock option is vested, you still don't own the stock. In order to own the underlying stock, you actually need to exercise the option. Exercising an option simply means purchasing it at the strike price. So it's actually going to cost you money. Exercising of stock options can be one of the more controversial topics in startups and one that most employees don't understand. There's a lot of restrictions and rules around whether or not you can exercise and when you can exercise. Some companies don't allow you to exercise while you're an employee because they don't want masses of people owning stock and voting. Some companies, when they're early stage, also are concerned about exercising because they don't want a bunch of employees pouring money into the company when it's still high risk. But the bigger controversy is what happens after you've quit. So let's say you've worked at a company for 4 years and then you quit. After you've left, after your 4 years vest, there's something called an exercise period. That's the amount of time you have to buy your stock option. The most common exercise period is about 3 months after you leave a company. So you got to make a decision pretty quickly if you want to buy the stock option. It's controversial because that stock option is risky and many employees don't have the capital to purchase their stock option. And if you don't actually purchase the stock option, it actually lapses. What that means is your option goes away and the stock option goes back into the pool of the company. Is it fair that your stock option that you've vested lapses if you don't purchase it? Fairness, honestly, is in the eye of the beholder. You have to think of stock options as an incentive scheme. If the belief of that company is that you should be sticking around for many more years after you've vested your stock, then that company may not believe the right incentive is for people to quit in 4 years and be able to exercise their options. They give you the right, but you may not want to part with them. Of course, many employees would like the exercise period to be 10 years so they can wait and see in the future whether or not they should buy it. I would say simply that it's a marketplace and that companies and employees need to decide what the right exercise period is, and you'll make choices about where you want to work. Finally, I want to cover the most simplistic view on how to value a stock option. The most simplistic way to start is to look at the strike price and the stock price. There's a $9 spread, and if you own 1,000 shares, it's worth $9,000. But of course, in order to figure out whether or not you think 10 is what the stock price is worth, you need to know a little bit about what the company overall is worth. You also need to have a view on what you think the future expected value. If it's a hot company, it could be worth 100 times what it's worth today. Part of starting to understand your value is understanding how many options you have relative to the total options in the company. If you own 1,000 shares of a company with 10,000 total outstanding, you own 10%, but if it's 10 million, you own 0.1%. Neither of those things are good or bad. I'd rather have 0.1% of Facebook than 10% of a no-name company. But here's the thing. If you know that the post-money of your last round of financing was 20 million, knowing whether you own 1% or 0.1% really matters. And if I do own 10% of the company, that's $2 million. But because of my strike price, I only get 90%. Mine's worth 1.8 million. There's a million more complexities I could give you on how to value stock options, but that would be more masterclass than useful. So I'm going to check out for now. And tomorrow I'm going to tell you about warrants and what warrants actually are.